Okay, we continue to track India's earnings season, which is on full swing. Steel maker JSW Steel delivered a healthy report card in the third quarter. Profits rose 63% year-on-year, thanks to strong revenues from its India operations, mind you. Net sales also jumped nearly 75% in the same period. The company reported healthy demand for steel as economic activity picked up in the region. It now expects to add up to 1 million ton in volumes in the March quarter. So the outlook is quite optimistic, sanguine as well. Seshagiri Rao is MVS, is actually Group CFO and MD at JSW Steel, joining us live from Mumbai with his thoughts on what's happened with the earnings and also to talk broadly about the steel sector in India as also the region. Mr. Rao, it's great to have you on the show, sir. Thank you very much for your time. Congratulations on a good set of earnings. Does the ride continue? I mean, you're talking about very, very strong volume growth, and also the demand environment, is that supportive? Given the backdrop that we're seeing globally, where I know prices have tumbled, you're generally seeing a risk-off sort of an environment coming on.
As far as India is concerned, in the last Q3, the growth in consumption month-on-month increased. It was almost 9% when compared to the Q2. For this financial year. But at the same time, if I compare with the Q3 of last year, the consumption has fallen by 7%. So what it means is basically the acceleration in demand, which were expected in the Q3 of this year or second half of this financial year, is not that much strong. But what we have seen is a bit of recovery in the auto sector in the last quarter. So the sales to auto sector we increased by almost 2%. For JSW Steel in the last quarter. We are seeing a bit of recovery in the auto sector in Q4. Over and above that, we are also seeing a good spending by the infrastructure sector of the government. So Q4 is expected to be much better than the Q3 which we have seen in India. As you rightly said, right. There are a lot of headwinds which we are seeing globally, so that has to be watched.
What to your mind is the biggest challenge right now from a macroeconomic perspective for the business cycle? Basically the
Omicron cases in the US and also in Europe are increasing. Number one, still they are not receding. Number two is the shortage of labor, due to which there is a big reduction in the economic activity in these two countries. So what we expect in this region is slowly Omicron cases will come down and the economic recovery will come back. Whereas this is one threat which we are seeing. Over and above that, as far as China is concerned, the property markets are not doing well. Even though it is expected that because of the stimulus which China is talking about, either in the infrastructure sector or in the manufacturing sector, it may go up slightly, but it may not compensate the kind of slowdown which we are seeing in the property market. So the Chinese demand, which has fallen, in my view, close to 5 to 6% in the calendar year 2021, in my view, it remains depressed even in the year 2022. So this is the scenario which we are seeing as far as the overall demand is concerned. The Omicron is a big threat, and the Chinese local demand is another area of concern. This we have to watch.
Another area of concern. But what may work for you is what the European Union has done in terms of reimposing the anti-dumping duty that I believe would benefit your European arm, as also the European facility of Tata Steel, and those duties have been imposed against imports from China, Russia and the US. How much of an edge does that give you, aside of local operations?
As far as India is concerned, there is a quota system, there is no anti-dumping duty. So therefore, European markets are still open for India. So it is possible to export within that quota from India. So that is a great opportunity for Indian steel companies to partially meet their requirements in Europe. So that I feel is the opportunity. Over and above that, as far as our operations in the Italy is concerned, it is expected to do better in the Q4 compared to Q3.
Just going back to the issue of your projection, your macro projection looking forward, how does climate fit in to your own personal analysis, the company analysis and industry analysis of what is going to happen in the coming years? I mean, the energy requirements and the pollution and climate effects of the steel industry are enormous, as you know. So where do you see that going?
As far as energy transition and the green steel, production of green steel is concerned, it is the core of Indian steel sector. So particularly JSW Steel, if you look at it, I think this is the company which has committed that what we would like to bring down the overall carbon emissions in our company by 2030. So there is almost close to 10,000 crores, in my view, $1.3 billion has been earmarked towards this initiative to reduce carbon emissions. So as you are aware that 70% of the total steel production globally is in the blast furnace route. So therefore, almost all the steel companies are taking efforts to ensure that the blast furnace steel making becomes efficient, the fuel consumption comes down, thereby carbon emissions will be brought down. But as and when hydrogen becomes affordable for using in the steel sector to replace coke, I think it will come over a period of time. The numbers today which are there is 28 million tons of steel is already announced through hydrogen-based steel making in the next few years' time. Gradually it goes up as and when the hydrogen becomes affordable. There is a huge amount of research going on. The industry has been very closely watching today. Every company's core strategy is the climate change and also the energy transition. And more in Indian steel companies are focusing to replace the fossil fuel-based power with the renewable energy power. In JSW Steel, we have 72% of the fossil fuel, 28% is other than fossil fuel. So gradually over a period of time, we would like to replace the fossil fuel-based power with the solar power. We already signed 1,000 megawatts solar-based and wind-based power, which will get commissioned in the next 12 months. So that will also increase our proportion of non-fossil fuel-based power.
Okay, so you're looking at that energy transition in a very serious way. Mr. Rao, before we wrap up, two questions rolled in one. One is you spoke about the demand outlook coming from China and how you're worried about the situation. How grave can that situation be going forward to impact the global steel industry, if you could add more color to that? And secondly, the outlook on prices for steel and iron ore, which we've been seeing fall.
As far as Chinese scenario is concerned, as long as they are disciplined in terms of reducing production, matching with the demand within China, I don't think global steel industry has to worry about China. This is exactly what has happened in the year 2021. When their domestic demand has fallen 5 to 6%, their production also they have curtailed. If you see today's report, even Tangshan region has already announced production cuts starting from 23rd of January because of the pollution. So one side, China appears to be committed to reduce the production, matching with their demand, not to increase the exports. In that scenario, I don't find a problem as far as the rest of the world global steel industry is concerned. Coming back to iron ore and coking coal prices, iron ore supply is adequate compared to the demand. Even China has imported lesser iron ore, almost 4% in the year 2021 versus 2020. Therefore, I expect iron ore prices to come down from the current levels, seeing what is happening in China. The second, coking coal is concerned, in my view, is quite temporary. So whatever demand supply dynamics are concerned, particularly China again, they have imported 52 million tons of coking coal in the year 2021 versus 75 million tons in the 2020. Almost 20 million tons of lesser coking coal production, coking coal imports. So it goes on coming down as far as imports by China is concerned. So if I look at if I just take out the temporary weather conditions and labor constraints which are there in Australia, the rest of the world, I think, is increasing the coking coal production, including Mongolia. So Chinese imports coming down, rest of the world other than Australia increasing the coking coal production. And if I just take out this quarter where Australian coking coal production is coming down due to labor constraints, I don't expect coking coal prices to continue at the current levels. There will be a correction downwards from next quarter onwards.
Mr. Rao, lovely to have you, sir, on the show. Thank you very much for covering all those points for us, and all the very best for the future. We are in the home stretch of Street Times. We'll be right back with a market wrap.